Hello, everyone. David from Mortgage Choice and Barrick. It is Tuesday, the 6th of December, and the Reserve Bank met this afternoon and increased interest rates by 0.25%. This was expected. The market was predicting a rate rise today between 0.25% and 0.5%. So the RBA has come out on the lower end of the scale, but in their comments, they've made it clear that they do expect further rate rises to come. They're still concerned about inflation, obviously. That's been the key concern for the last 12 months. And they're using these interest rates to try and slow down spending and slow down economic growth to try and stave off inflation and bring that down to a level that they're happy with. And it's going to be a long and slow process, unfortunately. So we're going to have a bit more patience over the next 12 to 18 months and see how this all plays out. I thought I would share my screen here and show you what interest rates have done since the early 90s and where we're at now, just to give you some perspective on where we're at. So I'll share my screen quickly and just take you through a little bit of a history lesson. If we look back to the early 90s, we can see the cash rate was quite high. I think interest rates back at that time were sitting in the 18 to 20% range. And you can see that they spent the majority of the 90s quite high, and it wasn't until the GFC in 2007 and 8 that we saw interest rates dive down, and then even further in the teens, in the last 10 years, we saw rates dive down even more. Now, this period here is where COVID hit, and we saw rates drop down even further to record lows, where we had variable rates sitting at around 2%. And then all of a sudden, this drastic increase up is what we've seen over the last 8 months, where they've increased interest rates by 3%, the Reserve Bank. All right, so it's been a massive correction and an adjustment as far as interest rates goes, and as far as what we've been used to for a very long time. We had 4 or 5 years where the rates just plateaued and did nothing. So the fact that we've had 8 interest rate rises in a row is a bit of a shock to the system. The Reserve Bank did make comment today that while they do agree that interest rates have gone up quite quickly, it does take time for these interest rates to actually affect the economy and to actually slow down spending, which is the purpose of these interest rate rises. So we're still looking at, again, another 6 to 12 months before we'll start to see the effects of these rate rises. The other thing to be mindful of is that half of mortgage holders are currently sitting on fixed rates. And they fixed interest rates when fixed rates were sitting at 1.8 to 2.2%. And those fixed rates aren't expiring for another 6 to 12 months. So as people come off these low fixed rates, we'll start to see the impact of these rate rises even more, because you're going from suddenly paying 2% interest up to close to 5% interest. And I believe that's when we'll start to see a bit more of a hit to the economy. But right now, the Reserve Bank is sitting back and saying, look, we've got really strong job growth. We've got wage growth. We've got record low unemployment and high vacancy availability and job ads going around. So it's a very strong market. And that's exacerbating this issue with inflation. So even though they've increased interest rates, the spending is still quite strong in the economy. And so they're having to continue to increase this interest rates to combat our spending. It looks like spending is starting to slow down. So they're expecting that in the next quarter, we'll start to see the economy turn and start to pull back a little bit. And that's hopefully a sign for the Reserve Bank to try and put interest rates on hold. So time will tell. The other question that a lot of clients have is, how does this affect the property market? So we'll quickly look at the Property Track Home Price Index, and this was released on the 1st of December. And I'll just zoom in here. We can see that Melbourne in this year has only gone back by about 5%. So $1 million property has lost about $50,000 of value over the last 12 months. So not a huge correction. I think the bigger changes in property values will likely happen next year. It'll be interesting to see how long the Reserve Bank continues to increase interest rates and what effect that will have on property values. But so far, it hasn't been that much of an adjustment. What I'd also like to show you is if interest rates were sitting at, say, 2.2% back in April, your repayment on a $500,000 mortgage would be around $1,900. This is back in April. Now, right now, you're probably looking at 4.75% that you'd be paying on a decent variable rate. And we're looking at $26.08 per month. Now, that's a difference of $710. So it's costing you an extra $700 a month towards this mortgage just between April and December. So it's a massive increase. If you can think of all the people across Australia that have mortgages, if everyone has $700 less per month to put into the economy, you could imagine that over time that's going to slow down the economy quite quick. So that's what we're getting to, is this eventual slowdown that the Reserve Bank is angling towards. What I'd also like to show you is an exercise that we take our clients through when we're doing a loan review. So as an example, if a client was with ANZ for their existing loan, and they've got no ongoing costs, but they've got an interest rate that's sitting at around 5.5%. And we look at a couple of lenders. So right now, HSBC is quite a good lender to look at. Their interest rates with this latest rate rise would be 4.5%, somewhere in there. And they're offering a refinance rebate of $3,288. And then we've got a lender like Bank of Melbourne as an example, who's offering 4.64%. And they're giving you $5,000 as a refinance rebate. So these refinance rebates is basically just cash that the bank is giving to you as an incentive to win your business. So there's no catch, there's no trick, there's no requirement for you to stay with them long term. They're just giving you cash to try and incentivize you moving over to them. And to also help the cost of moving, because when we look at switching banks, it's going to cost you roughly $700 to move banks. So with all of that factored in, when we compare HSBC and Bank of Melbourne to this existing ANZ loan, over a 3-year period, we can see that HSBC is better off by $17,588. So that's good math, right? That's more money in your pocket and less money in the bank's pocket. The Bank of Melbourne option versus ANZ, $17,200. So what we're seeing here is a difference between the interest rates and the refinance rebates. And so there's a little bit of a balancing act that we need to look at when we're working out what lender is best for our clients. So what I would recommend to all clients watching this video, if you haven't done this exercise with us recently, say in the last 6 months, then definitely give us a call, get a meeting booked in, and let's run through your specific situation and work out what potential savings you could get. All right, we're looking at 2 main things. One is the interest rate savings. Are you sitting at a higher interest rate like this pretend client here at 5.5%? And can we get you down roughly 1% lower? That's a massive savings in itself. And then you've also got the refinance rebates where banks are giving you cash to win your business. All right, so just keep that in mind. If you haven't done a review with us in a while, give us a call and we'll try and see how best we can help you out. I am sure that there are plenty of clients right now that are starting to get a little bit concerned about their financial situation. If that's the case, do not hesitate. Give us a call and let's run through how we might be able to assist, what changes we can try and implement in your financial position to try and help you out. The last thing that you want to do is put your head in the sand, pretend like there's not a problem, and then wait and wait and wait. And all of a sudden the problem is too big to handle and too big to recover from. So if you've got concerns about your situation, give us a call and let us know. Also, if you know of anyone that could also benefit from a review, please let us know. We've had so many clients referring their friends and family because they're not being looked after by their bank or their existing broker. And so we're getting so many referrals from friends and family and work colleagues where clients are concerned about their situation and saying, hey, can you give David a call and see if he can help you out? And we love getting those calls. We love helping clients save money. And it's a very easy process for us to work through and determine if there is some savings available. So hopefully everyone has a great Christmas. We don't have to worry about Reserve Bank meetings for another couple of months because they don't meet again until February. So no videos like this giving you bad news about rate rises in January. So enjoy yourselves, enjoy your holidays. And again, if you've got any questions or concerns, reach out to us. Always happy to help. Thank you.